Now, I would like to get started. Our last presenter, Danny Warshay, suggested that we ask Troy Henikoff, class of '86, another successful Brown entrepreneur, to continue the conversation on this topic of entrepreneurism. And I'm delighted that he agreed to join us today. Troy, we are really excited to have you share with us your experience and expertise. So welcome.
Great, thanks. Can you hear me okay?
I can hear you great, and you are now in charge.
All right, I got the controls. You're in trouble now. All right, so I want to talk a little bit about the next steps of building your business. We'll go through a quick agenda, and then we'll get right into the meat of it. I'd love you guys to come up with questions. This is more for you than it is for me, obviously. So the more we can get questions at the end, that would be great, and I will leave time for questions at the end. So we're going to talk about the different stages of a startup. One of the things that has changed over the last few years is that how we think about startups. We used to think about them as just smaller versions of big businesses, and we definitely think about them differently now. How to get to the front of the pack, what you need to do to be successful with your startup as it starts to grow. Financing, there are a lot of different financing options, different ways you can go on paths, and then some of the resources that are available to people. So I want to give you a little quick background on who I am and why I'm here speaking to you. So I started my first company right out of Brown, basically 1986. I was an engineering student. I had an engineering degree. I knew nothing about business, and all I knew was that when I went to interview with the big engineering companies, that I did not want to work for them. I had a job offer with General Dynamics to be one person in a cube that was a football field of cubes in Groton, Connecticut, that was one of 5 floors of football field of cubes in Groton, Connecticut. And the person making the job offer said to me, I am so proud. I just completed finishing the design of a hinge for a submarine door that I've been working on for 18 months. And he was excited. He thought that was awesome. And that was like my worst nightmare, working on this little, being a cog in a wheel of for 18 months. So I didn't know much about business, but what I did know is I had spent the previous 2 summers doing some consulting work, and that I could solve people's business problems with technology. The PC was becoming a legitimate business tool, and they would pay me for it. So I decided to start a business, knowing nothing about starting businesses. And Heather asked me to talk a little bit about how Brown played into this, because we don't have a business school. We didn't have business classes. What I think Brown did that was really interesting was, because of the new curriculum that's now, 48 years old, I don't even know if it's still called that, but we had a lot of flexibility. We were told to be in charge of our own education. We didn't have the required courses. And so what ended up happening was you built confidence that you could figure this out and you could do it. And I think that combined with the experiences outside of the classroom and the people that I interacted with gave me the confidence to go out and just start a business. I didn't even know what it meant. As a matter of fact, when I was about 1.5 years into it, this is a true story. I was about 1.5 years into it. I was at a party, and I was talking to a woman, and she said to me, well, what do you do? And I told her, and she said, well, it sounds like you're an entrepreneur. And of course, I was trying to impress her, so I said, well, yeah. And that evening, I had to go home and look it up in the dictionary because I didn't know what entrepreneur meant. It wasn't part of our vernacular. But Brown gave me the confidence to go do that. And I started a company called Specialized Systems and Software. Danny Warshay was one of my co-founders in that business. We grew it. We sold it to Medline Industries and ran that for about 11 years. But I've done a bunch since then. I've been what you call a serial entrepreneur. I've been involved in building a number of businesses and some of the logos you see on your screen. Hopefully you guys have heard of some of them. Jellyvision was actually founded by another Brown alum who I then joined to build the technology for. Sure Payroll, we grew to be the largest payroll company in the largest internet-only payroll company in the country, and recently sold to Paychex. So I've built a number of companies. Currently, I'm the CEO of Excelerate Labs. I'm going to tell you a little bit more about Accelerate as we get into this call. I manage a fund, a seed stage investment fund called Firestarter Fund with a couple of other people. I teach both at Northwestern University of Chicago in the Kellogg School of Management and the Booth School of Management. For those of you who know Chicago, it's kind of unusual, so I'm the only one who I know of that has a foot both on the north side and the south side into competing business schools. But it's really fun. My attitude is more I am here to help entrepreneurs than it is that I have an allegiance to a particular school there. And I've been an angel investor. So in the last handful of years, I've made roughly 21 direct investments. And the takeaway from this is that I've been on both sides of the table. I've been an entrepreneur. I've built companies. That's where my passion is. At the same time, I invest in companies. So both as an angel and from a fund standpoint. So I've been on both sides. So let's talk about the types of entrepreneurs, just to level set a little bit. There are lots.
Troy, before
Yep.
you go too far, I know for me it was really interesting when you went into a little more depth about your role at Sure Payroll and sort of that process. Do you mind talking a little bit more about that?
Sure. So Sure Payroll, 3 of us started in 1999. The idea was that at that point we realized we literally were at breakfast and kind of said, hey, this internet thing, I think it's going to stick. It's around. And people were starting to pay their bills online, right, about 1999, and nobody was paying their employees online. Today that sounds absurd, but 13 years ago it was the case. And so we said, hey, we could make this process simpler if we leveraged technology to take a lot of cost and time out of the process. So we could allow, and we're focused on small businesses, so we could allow those business owners to log in online, see what they paid them last time. If the pay was the same as the last pay period, hit one button, everybody gets paid electronically. It's like magic, as opposed to dealing with all the hassle of the existing, what we called legacy payroll, which was calling into a call center, having someone key stuff into a mainframe, there are mistakes. They have to drive in a car to deliver you checks and reports, and you have to sign off on them. It was just a very expensive and difficult process. So we created Sure Payroll. We raised about $17 million of venture capital along the way. We survived the bubble, so we didn't raise our first round of funding until after the bubble of 2000 burst. We were actually on Sand Hill Road in the mecca of venture capital the week that the bubble burst. It was lots of interesting stories there. And we ran the business for 11 years, ultimately selling to Paychex for over $100 million. So it was a nice exit for our investors, and it was a great ride. I'm an early stage guy, so I took it from an idea on the back of the napkin, building out the business plan, hiring the team, building the technology, getting it to about 80 people, roughly cash flow positive in a recurring revenue business. There's whenever you get cash flow positive, you take that extra cash and you go hire another sales rep so you can put more on the top line. And then it got to the point where I had managers reporting to me about the people they were managing, and that's not my gig. I'm an early stage guy. I like to get dirt under my fingernails, and so I turned it over, and Michael Alter, who's been running it the last handful of years, has done an amazing job and took it the rest of the way. So it was a great story and a really fun ride. Learned a lot along the way.
Thanks for sharing.
So getting back to the stages of a startup, so that's one type. So Sure Payroll was clearly what I refer to as a high-growth startup, right? The goal of it was to build a bunch of value and to grow the company so that there would ultimately be an exit. And just to be clear, nobody pulled money off the table until that exit 11 years into it. So when we raised $17 million in venture capital, some people think, wow, that must be great. Your bank account. No, that's the company that has that money. I still got the same salary I got before we raised any money, and that money is there for the company to use to grow. But there are a couple other types of entrepreneurs. There's what I call lifestyle entrepreneur. Let's say you were passionate about golf or tennis and you wanted to be a tennis instructor. You can make a nice living being a tennis instructor. That's awesome. You're an entrepreneur. You're in charge of your own destiny, your own time, but that's not what we're going to talk about today. There's also what I refer to as a salary replacement entrepreneur. For instance, you may purchase a franchise of a 7-Eleven or a Subway sandwich shop or something along those lines. You're going to work really hard. You're going to hire some people. But it really, at the end of the day, you're not building a high-growth enterprise. That's a job replacement. But, again, you are an entrepreneur. You're setting your own hours. You're getting compensated for how well you do. We're going to focus on this high-growth segment, which is the people who are trying to build businesses to grow rapidly. So that's what we're talking about today. And the first phase of them is a phase that I refer to as search. So Steve Blank, who's very famous, I'll refer to him a couple times, who teaches at Stanford, courses in the Lean Startup, talks about how a startup is really a temporary organization designed to discover a business model. And you're in this search phase. You're trying to figure out where the model is, where's the right value proposition, the product market fit. And hopefully most of you who are in this space have read Eric Ries's book. Eric was a student of Steve Blank, The Lean Startup. It's sort of in the last year and a half, and it's amazing that it's only a year and a half old, but it has changed the way we talk about startups. One point I want to make is that successful startups were doing a lot of this stuff, like Sure Payroll. We did a lot of the Lean Startup stuff back in 99 and 2000. We just didn't have the language to describe it, to call it an MVP. We were just doing it because we knew it was right. So if you haven't read the Lean Startup, you definitely should. Product market fit, et cetera. That's this early stage stuff. Business Model Canvas is an amazing tool for you to use to put some structure around how you think about a business in this search phase. And for those of you who haven't used it, the way you use this canvas, there are these 9 boxes that describe the customer segments and the channels, and you actually are supposed to use Post-it notes that you put in each segment of what your current hypothesis is. And the reason you use Post-it notes is to emphasize the fact that you don't really know. And so when you prove or disprove a hypothesis, if you disprove it, you'll take that Post-it note off and put a new one on in its place. Very different from how we taught entrepreneurship 15, 20 years ago, which was, I'm going to go write a 20-page business plan and then execute against it. Here, we've recognized the first part is the search part. And this is the stuff that I think the previous speakers have spoken a bunch about. The goal here is to come up with a great business model and to do it in a large market, at least large enough, right, so that you can actually grow this company to be of meaningful value. And now comes the next phase, which is execution and scale. You have to be able to scale it. This is where the real value is made. Many people believe the value is in their idea, and I disagree strongly with that. The 90% of the value comes from execution. So the problem with that is that execution is much more difficult than most people realize and give credit to. Frankly, if I knew how hard it was going to be to run Sure Payroll and start it, if I knew then what I know today, I may not have done it. It was really, really hard. In the U.S., there are over 4,000 taxing entities that we had to interface with and pay taxes for our customers. And when we messed up, they fined us, and it cost us money. And it's getting customers. It's just much harder than you think. So I tend to think about this as there's a portfolio of skills that you as the entrepreneur need to have in order to be successful. And you get these skills in 4 buckets. So the first bucket is there's things you can learn from books. You have to be a sponge. You have to be reading books. You have to be reading blogs, watching videos. There's tons of stuff that you can just go absorb on your own. Lots of great things. And that's awesome. The second bucket is there's some things that you can only learn from others. An example of that is if you're in business and you're having an issue. Let's say you're letting someone go, you're firing someone for the first time. To go speak to someone who's a mentor who's been through this before, who can guide you based on the particular circumstances that you're in and say, whoa, you need to have a lawyer before you do this because you're potentially liable for a suit against you for discrimination or for whatever it is. Or, here are the check boxes you need to be careful that you check off before you do this. For good things as well, you're going into a negotiation. To be able to sit down with someone and explain where you are in this negotiation and get that feedback and say, oh, I've seen this movie before. Let me tell you how this one's going to play out. Here's how you should position it. Really, really valuable. Things you can only learn from others. You can't get that stuff from a book. And so how do you get that? Well, you need to find those people that you can learn from. Go to meetups. Meetup.com has lots of them. There's a guy named Mark Suster, who's a blogger, who wrote a really great blog, Why You Need to Take 50 Coffee Meetings. Basically, anybody you know who you think you can learn from, go buy them a cup of coffee. Sit down with them. You will learn so much. And I want to emphasize that with mentors, we're looking for people who really care about you, care about your business. So particularly in the go-go days of the Internet, there were people who had put together a board of advisors, and it was sort of window dressing, right? My sister actually was in a company, and John Chambers, the CEO of Cisco, was on her board of advisors. What that meant was he said, yes, you can put my name on your board of advisors. He never showed up to a meeting. I'm sure he's a very smart guy. He's done very, very well, but he wasn't there to help them in a meaningful way. You need a suite of people who really care about you and care about your business, that you can pick up the phone and you can ask, call them and call on them when you have these questions. So people who really care. The next category is there's some things you can only learn by doing. And I'll give you some examples, but my message here is you got to go kiss a lot of frogs before you kiss that first prince, because you want to be practiced at it. You want to be good at it. So whether it's raising money, and you need to go out and pitch a lot of times before you get to the ones that really matter, whether it's, at Accelerate, we do a lot with bringing in mentors and doing pitch practice and putting people in the hot seat. We do a lot of mock-ups inside our program so that when they do get out there and they're talking to that first VC, they're comfortable with what kinds of questions are going to be asked, how you respond to questions. If you think about it, a trial lawyer, there's some great trial lawyers out there. And I'm betting that in their first trial, they weren't so great. It takes time to become great at that, to be able to read the jury, to be able to anticipate the questions, to be able to respond properly. And so there's some things that you can only learn by doing, and you've got to get out there and do it. And so find the low-risk one. So if you're trying to raise money, for instance, go talk to the people who you don't really want to necessarily raise from first, because if you mess it up, it's okay. But every experience will get you that much better so that when you do get to the ones that matter, you'll be ready. Let's see. Oh, the fourth category is having the right DNA. And this is something that I think is really important. We're all wired differently, right? We have different problem-solving skills. There are different things that interest us. And so great entrepreneurs tend to have this bias towards action. They're comfortable with uncertainty. They love the discovery process, doing things that haven't been done before. And this one I get to pick on my wife. So she's way smarter than I am. She has multiple graduate degrees. She's an attorney with a graduate degree, an LLM. But she would be a really bad entrepreneur. First of all, as an attorney, how many attorneys have a bias towards action? If you've ever dealt with attorneys, you don't pick up the phone, call your attorney, say, hey, I'm thinking about doing this risky thing. What do you think? Should I do it? And have them say yes. That just never happens. So, and she doesn't like uncertainty. She likes things that are where there's a well-defined process, and she follows that existing process. So in spite of the fact that she's smarter than I am, she wouldn't be a great entrepreneur. So you have to look into yourself and say, wow, is this really the lifestyle? Is this really the stuff that I love to do? And if you're someone like me, you can't picture doing it any other way. I can't picture living without some uncertainty, without new problems and new challenges. That's what gets me up in the morning and what I love.
Hey, Troy, there was a
Yep.
couple of articles about entrepreneurs and, their background and, a lot of people who start without any education. And you talked a little bit about what Brown gave you. But also there's a very high percentage of entrepreneurs who come from Brown and Ivy League schools. And do you see any correlation between education and entrepreneurship, or, successes of those? What do you feel? How much of that do you feel like you need?
Yeah, it's a great question. So I think that much of what you learn in the classroom doesn't matter quite as much with entrepreneurship. That it's a lot more of what you learn in real life. Now, I think there's a high correlation between people who are genuinely smart and insightful, and they're being successful running businesses. And I think there's a high correlation between those smart and insightful people and people who get into Ivy League schools and schools like Brown. So there's probably a very high correlation. I don't know that it's a causation there. There's also been some discussion about whether you need that formal education or not. So Peter Thiel has, I forgot what he calls it, he was giving entrepreneurs in undergrad money, I think $100,000 if I'm not mistaken, to quit college and just go start their business without ever finishing college. I don't think that's a good idea. I think I learned a ton through my college years, whether it was outside the classroom or inside. There's some question as to whether or not you need an MBA to start a business. I teach at the MBA level, have been interacting with them. At Accelerate, roughly a third of our businesses are MBAs. I don't see that people who have MBAs necessarily do any better. You do definitely learn some skills, and most importantly, you get a great network from that experience. the value of the network in that, going to a top-tier MBA school is phenomenal. But lots and lots of people are doing it right out of undergrad or before getting an MBA, and I think that's fine.
I wanted to say I'm pretty sure that there is a Brown student who won the Peter Thiel Award last year and is now not attending Brown. And I bet one of our somebody on the call might be able to send us that information. Thanks for clarifying that. That was really good.
Sure. So investors as a source of cash. So there are a lot of different buckets of investors, and we're going to talk about a few of them. So the first is friends and family. Those are people who you already know who are really betting on you. The second is angel investors, and I'll define what this is in a minute because people get confused. When is it friends and family? When is it angel? When is it venture? Where's the line between angel and venture capital? The next level is private equity, and finally public markets and IPOs. We're not going to talk about the last two. We're going to talk about friends, family, angel investors, and venture capital because that's what's most applicable to startups. By the time you're dealing with private equity and IPO, you're no longer a startup. You're well on your way. So friends and family I view as, first of all, they're investing in you. They're not investing in your business most of the time. There are exceptions to this, but most of friends and family are really people who believe in you as a person. They want to invest in you. They're happy to help you. And usually what you're getting is cash. You're not getting a lot of management experience, domain experience, coaching, mentoring, etc. There are exceptions. If you have friends or family who have great experience, that's awesome. But keep in mind they're investing in you. The other thing that you have to keep in mind is that you're putting relationships at risk. Imagine sitting at Thanksgiving dinner across from Aunt Ruth, who invested $25,000 or $50,000 into your venture that she was counting on for retirement, and it's all gone. It's lost. Is that what you really want to do? Versus if you are taking money from professional investors who understand this is an arm's length transaction, understand the risk associated with it. So be very careful about friends and family and putting those relationships at risk. Ask questions. Can these people afford to be investing? You don't want to take Aunt Ruth's last $50,000 that she's counting on for retirement. Are they investing wisely? When you look at the portfolio approach, and we'll talk about that with venture capital, even the best VCs in the world, they'll invest in 10 companies and 4 of the 10 will fail. So they aren't good enough at picking only winners, so they have to have a distributed portfolio approach. So why would an angel or an individual friends and family person be willing to make one bet? That's probably not a wise way to spend your money. And you don't get that much mentorship again unless you're lucky. Angel investors, again, they're investing their own money. My definition of angel investor is someone who's investing their own money as opposed to someone who is investing on behalf of others in a fund. And so angel investors can sometimes write very large checks if they have a lot of money. I don't define the difference between angel and venture as the size of the check, but the process. Because they're investing their own money, they can choose to invest for whatever reason they want. They could look at you, say, I love the color of your shirt, I'm going to invest. They don't have to answer to anybody. They can actually do that. Typically, they don't. They're doing it for a reason, and the reason is typically that they want to make money, but they want to be involved in these early-stage startups. And they like being involved and like being able to help, and it's their way of giving back. But be careful. They want to help out, but they may want to help out more than you want them to help out. I have definitely seen this. They believe that since they wrote a $25,000 check to fund one of these businesses that they have the right to show up all the time and ask lots of questions and look over your shoulder, and that may not be what you want. So you have to decide. There's definitely some compromises to be made here. Angels are harder to find than friends and family, if you don't already have a network. But there are a number of angel groups out there. So here in Chicago, where I am, there are at least 5 or 6 of them. A number of them associated with universities. So Northwestern has the Wildcat Angels, and University of Chicago has Hyde Park Angels, and even universities that aren't in this city. So there's Harvard Alumni Group has an angel group, as well as does a Notre Dame here in Chicago. So there are a number of angel groups. And there's even online angel list. For those of you who haven't seen it or participated, is a very interesting play. It's been up about 2 years. It's very active. Many companies looking for angel financing will post there, and then people who are accredited investors, and you have to be both an accredited investor and you have to be vouched for by somebody who's already an accredited investor and on Angel List, will come on to Angel List and register, and then they can look through those companies. And a number of companies have had large success finding angels through Angel List. So that's angel.co. But venture capital, this is what most people tend to talk about and think about in terms of fundraising. Yes, they tend to be larger rounds of funding, more dollars. So our first round of funding for SurePayroll was $8 million. That's public information. The size of the rounds have been going down over time. It takes less money to build a company today than it did 13 years ago. Software's cheaper, hardware's cheaper. You don't have to buy all the servers, that sort of thing. But venture capital tend to be larger checks, tend to be 7 figures or more. The important thing to realize is that they're investing other people's money. So the way a venture capital firm works is it's sort of like a mutual fund, but a mutual fund that has selected that instead of investing in treasury bonds or in overseas, or it's investing in early stage startups, typically within a niche. Different VCs will have different niches. And many of them are very public about their themes or their niches and what they do and don't invest in. And that's good because they're specialists. They know a particular area very well. Some will invest only in healthcare. Some will invest only in IT. Some will invest only in consumer-facing startups, consumer-facing internet. But the point is that they're investing other people's money. So a number of people write checks to them. Those people become called limited partners or LPs. The venture capitalists are the managers of that fund. You're hopefully selecting a fund where you really trust the managers. You think they make good business decisions. Those managers get a small fee every year to manage the fund. Typically it's 2%. And then they make investments in startups or whatever phase that their fund is, but generally fairly early stage. When those companies exit and have a sale, that's when the venture capitalists collect the money. Hopefully it got a multiple of what they put in, and then they distribute that money back to their LPs. The way they really make money is once they've returned all of the capital that the LPs have invested, from then on, for every dollar that comes in, they get what's called carry. It's typically 20%. So if you were an LP, you put money into a fund, you would put your money in, you'd get charged that 2% every year. Once you got all of your capital back, from then on in, on the profits, you would get 80 cents of every dollar, and the VC would get 20 cents of the dollar. This is aligning your interest. The point of this whole thing is that they have a fiduciary duty to make money for their investors, and they are highly motivated to do so. So they're investing other people's money. There's only one reason they'll invest. It's not because of the color of your shirt. It's because they think they're going to get a return. There's much more rigor in this process, not just in the process of selection, but in the supervision. So typically, they're going to want a board seat. They're going to want to help manage that company at a high level, not day to day, but they're going to want to have some oversight, at a governance level, and they're shooting for a big return. So let's talk about the economics real quickly. This is back of the envelope, but for every 10 investments a venture capital firm makes, typically 4 are going to fail, be worth 0. 3 will tread water, 2 will do well, and 1 will hit it out of the park and pay back the whole fund. So if you know that, and you're making these investments, you don't know which one is going to be the successful one out of the 10, but you know that you have to only invest in things that, if they are successful, can pay back the entire fund. That means you need to have a minimum of 10 to 20 times return. For every dollar you put in, you have to be able to get 10 to 20 times back. So if you're pitching venture cap, because what you don't want to have happen as a venture capitalist is have your one home run be a company that did really well and returned twice its money. That's great for that particular investment, but it has to make up for all the losers that were in that fund. So if you're pitching venture capital, it only works if you have a business where there's a clear path to being able to give your investors 10 to 20 times the money they put in. And that's really important to understand up front, so that you can understand how they make decisions about who they want to invest in. And they definitely are more difficult to get to. Pretty much you have to have an introduction. The funnel for venture capital generally, again back of the envelope, is that for each partner in a firm, they'll see 1,000 business plans in a year. 1,000 business plans. They'll probably only read 100 of them. They'll probably only go deep with 10 of them, and they'll probably only make investments in 1 or 2 per partner per firm. So if it's a firm with 3 partners, 3 times that in a year. So the way to get past that first filter is to have someone who knows and is respected by the venture capitalist introduce you. If you just email in a business plan or a financial executive summary, the odds that it's even going to get read are very low. So they are more difficult to get to, but can be a great source, obviously, of capital. And then the other thing you have to wrestle with is that because the VCs need to get the kind of return they need to get, they have to have a significant portion of your company. If you go with venture capital, you will typically have a smaller percentage of what should be a much bigger pie. Hopefully your slice of pie will be worth more. It should be accretive, not dilutive. So as they invest money, you have a smaller percentage of something that's worth a lot more, and so what you own is worth more. Some people have trouble getting their head around that, but that's how it works. Other things you can do to accelerate your process. So co-working spaces are popping up all over the country. Here in Chicago, we have a number of them. The one I work out of is 50,000 square feet. 400 entrepreneurs a day are coming there representing 200 companies. It's an amazing place, and it's great. Not only is it flexible lease terms month to month, but all the entrepreneurs are there. There's critical mass. Investors are coming in. Mentors are coming in. There's just so much activity that things happen spontaneously that wouldn't happen if I were working out of Starbucks or still working out of my basement like when I started my first company. It's a great way to find these mentors, and we talked about this a little bit, you definitely need to have formal or informal mentors. I think that's a big, big deal. There are other things. There's something called the Founders Institute. There isn't one in Providence. There is a branch in New York. There's one in Chicago. It's sort of like a class, an evening class that you actually go to with a bunch of other founders of startups, and they're literally teaching you some of the skills that you need in order to be a successful entrepreneur. And then there are accelerators, and I'm going to talk about this in a little more detail because this is where my passion is. I do want to say that not all are created equal, and I'll talk about ours in a minute. If you're interested in learning more about all the accelerators or many of the accelerators that are out there, there's an organization called the Global Accelerator Network. Full disclosure, I'm an advisor to them and have helped them get off the ground, but it's GAN.co that has as members, I think we're up to 55, 60 accelerators around the world, and you can get access to information about them, their results, how they've done, links to applications, etc. So Excelerate is an accelerator. It's one that I helped found 4 years ago, and I'm going to tell you a little bit about how it works, and then hopefully you'll see why it's valuable. So last year we had 400 applicants who applied for 10 spots in this accelerator. These, by applicants, these are companies. They're typically pre-revenue. We had 2 of our 10 had some revenue, but it's highly competitive. That's 2.5% acceptance rate. So when I went to Brown, I thought that it was highly selective. I think they admitted, I don't know, was it 18%, 20% got admitted? Today I think it's a fraction of that. But at 2.5%, this is more highly selective than any university or grad school in the country or the world. We take the 10 that we admit and we wrap them with what they need to be successful. So they get seed capital, they get $25,000 from us, they get $50,000 in convertible debt from a venture capitalist, so they have $75,000 to work with. They get free office space for a year. Free office space for a year inside our space. Hosting, accounting, legal, all kinds of services. We have lots and lots of promotions, none of which cost them a penny. We have a very bright line that we don't promote anything that costs the entrepreneur money. And most importantly is more mentoring than they can possibly handle. We have an amazing group of mentors that I'll talk about in a minute. And with that, they run through this 90-day, really intense boot camp for companies. It's 3 months, summer, June, July, August, that culminates at the end with Demo Day at the House of Blues. And what that means is that at the end of August, they've completed the 3 months. Each of the 10 companies gets up on the main stage at the House of Blues and pitches to a standing room only audience of roughly 500 investors. And the goal is for them to obviously raise money to help build their business. So I'm going to talk a little bit about how it works, just to give you some perspective. So June is what we call Mentor Dating Month. You see I have a photo there of one of our mentor boards from, I think that's 2011. You see that big number 740 right there in the middle of the board, top middle of the board. That's how many one-on-one meetings there were in the month of June. The little number that you can barely read there says 145. That's how many mentors did the 740 meetings. So we had 740 meetings in 19 business days. It is totally crazy. These are the people who did it. They fall into two buckets. So one bucket is people who actively invest in digital technology companies. So you'll see people, I don't know if you know any of these names. David Cohen is who started Techstars down in Boston. I'm down in Boulder. Brad Feld, Ron Conway, there's Brad, some really great investors from Chicago, from all over. The other bucket that they fall into is people who have successfully built digital technology companies. On that board are the founders of Groupon, Grubhub, OpenTable, CDW, Priceline, OkCupid. The list just goes on and on. It's an amazing list of people who all donate their time. And so what happens in mentor dating in those 740 meetings is that two things happen. The entrepreneurs get their business plans torn to pieces. And the reason that's valuable is it's much better to find the flaws in your plan in 30 days without spending a lot of money and actually executing than it is to do it over the course of the next 2 years, wasting a lot of time and money. So if you can identify those flaws early, and their business plan is typically in pieces on the floor of the office, and they have to pick it up and figure out what pearls of wisdom did they get? How can they put it back together and make it even better because of all the critiquing they had? And the second thing is that they've built really great relationships. Typically 3 to 5, this is the dating part, 3 to 5 of those mentors take a liking to a particular company. And the chemistry has to go both ways. And when the chemistry goes both ways, then they build a relationship and typically say things like, come to my office every Wednesday at 8 o'clock in the morning and we'll meet for an hour and I'll help you. And so they get a lot of one-on-one mentorship and build relationships, and that network is incredibly valuable. The second thing that we do is in July, the month of July. So we cut the mentor dating off in June. The month of July is what I call an Entrepreneur's MBA. And the Entrepreneur's MBA consists of every single day a 90-minute session from someone different who gives a seminar on one of the things that they need to have to be a successful entrepreneur. So it's not just I have an iPhone app. You actually need to think about things like customer acquisition cost, lifetime value. How do I manage a board? Do I take venture capital or angel? What are key performance indicators? SEO, SEM, PR, HR. There are all of these topics that you need to be exposed to. They won't be experts in any of them, but we literally put on 22 to 25 seminars in the month of July so that they can be exposed to these topics. The rest of the time is theirs to start executing on their plans from what they learned from mentor dating. And August is prepping for demo day. So it's the only time in your life you're going to get to pitch to 500 investors at once. You better make it count. And there are two things we do for prepping. The first is hopefully you have some great engagement metrics, so you've really done the things that you need to do to be successful. So if you're a B2B play, maybe you have your first 2 enterprise beta customers. If you're B2C, maybe you have your first 200,000 downloads of your iPhone app. Whatever it is that you need to prove engagement. And the second thing is that pitch better be really good. They're 10-minute pitches and really tight. So they practice those pitches over 100 times each. I actually sit and watch pitches every single day of the month of August. I bring my kids in the office on the weekend. It's the only time I would get to see them, etc. But the end result is that our demo day is an amazing event, and the investors love it, and that's why we get so many of them. They fly in from all over the country. So let's talk about results real quickly. So it's really great that we do all this, but to what end? So we've run 3 years. Our first class graduated the end of August of 2010, so roughly 2.5 years ago. We've run 30 companies through it, 3 classes of 10. Those 30 companies have raised over $30 million and created over 150 jobs. So the way I like to think about it is if I told you I have a company that's 2.5 years old. We've raised $30 million. We have 150 employees. It's a hell of a trajectory, and it is a trajectory. It's been going up every single month. At this time last year, I would have told you it was $18 million and 100 jobs, so it's definitely growing. Forbes did a ranking of accelerators around the country, ranked us number 3 behind Y Combinator and Techstars. Kauffman Foundation did, did a worldwide ranking of accelerators last year. It ranked us number 3 as well. So we're getting some recognition for that, and it's really, really fun.
Hey, Troy, before you go on, can I ask a couple of questions about that? Because I know you have some recommendations, but as you were talking, a couple of questions came up to me, and at Brown, when people are talking about career counseling and they're saying, it's hard to get in, you need to look at your other options. So when I'm looking at what you said about Accelerate Labs being 2% getting in, if they have to look at other accelerators, what do they look for? What would make it a good accelerator? What would you, if you were going to apply somewhere, what should you look for in your accelerator?
So accelerators are a relatively new phenomenon. The very first of them started about 6-7 years ago, and there were only 2 really. It was Y Combinator and Techstars. Most of them we were at the early stage, about to enter our 4th season. You want to look for results and what's causing those results, and I believe it's the mentorship that's the thing that's most important. So I would look to who are the mentors, what are their experience. So we have a whole, if you go to Accelerate Labs website, you'll see a whole page with well over 100 mentors and links to their photos and background and et cetera, so you can see who they are. It's hard. At the end of the day, we'll be able to measure accelerators by their results. And by results, I don't mean how much money they raised or how many employees they have today, because that's an indication of some progress, but that's not the result that matters. What matters is, did you build lasting companies that created real value? And so it's all about the exits. The problem is that since we've only been doing it for 3 years, we only have 2 exits so far. So from our first class, one company sold to Fango, sold to Grubhub, and FeeFighter sold to Groupon. So we've had 2 nice exits. They weren't huge. It wasn't Airbnb or Dropbox, but they were nice. So what I would look for in accelerators is who are the mentors and what kind of track record do they have as an accelerator, what kind of track record do those people have as business people. That's the stuff that matters, and there is a big, big stratification. I think there are a lot of people who saw this model and said, oh, I'll just do that. I'll get some office space. It'll be really easy. And they didn't realize how hard it really is.
So that on the flip side, as the accelerators, what are they looking for in the startups and the proposals?
So what we're looking for, we're looking for great entrepreneurs, which is hard to tell because most of these are first-time entrepreneurs. So we're looking for really smart people who have a really interesting idea that they can execute against in a big market, so they can actually make a difference. So traction is one of the most important things. And I want to be really clear. By traction, I don't mean you have to have hundreds of thousands of users. I mean that the users you have really are committed to what it is that you're doing and are demonstrating that through their behavior, not through their words. So as an example, when Facebook was first launched, it was launched to Harvard .edu email addresses only. You had to have a Harvard.edu email address. And within 30 days, 75% of the people who had a Harvard.edu email address were signing on to Facebook daily. Now, Harvard probably couldn't get 75% of their faculty to sign on to a new email system that they built, that they mandated in 30 days. Like, they couldn't get that kind of compliance, but people were doing it voluntarily. That was an indication of just how engaging that application was, that experience was. It wasn't huge. It was just a couple thousand people, but they were so engaged. And so those kinds of metrics, engagement metrics, are the things that we're looking for that are so valuable.
I know I'm not necessarily following where we were going to, and we are going to get to, just recommendations and then open lots of questions. But there was one specifically related to what you're talking about. Can you talk about business incubators versus business accelerators? Should one type of business seek out one? Are there different kind of business ideas for the
Yeah, so the term incubator has been thrown around a fair amount. I talked about what a co-working space was, right? That's just flexible lease terms. Incubator generally, to me, means that it's an organization that has some office space. They typically have some other resources as well. So they may have a couple design people, a couple programmers. You come in with an idea, they will help you with your idea, and they will take a significant piece of equity in order to do so. It varies. Could be, it's double-digit percentages for sure. And they'll invest some of their time and their people to help make your idea real, and you will be partners with them. And they typically take them as they come. So they'll work on maybe 1, 2, 3 projects at a time. With an accelerator, we're doing a cohort group, so all 10 start and finish at the same time. There is a little bit of equity, so we're right in line with the market. We give $25,000 in cash to the company. We get 6% common stock back. But that's a much, much, much smaller equity piece than you'll see with an incubator type of situation. And we're not their partner. We're an investing partner, but we have no management say. We're trying to help them as much as we possibly can. So which would it be better for? If you had just an idea and you didn't have the technical skills to create that idea, a business incubator may be a good idea. They were all the rage in 99 and 2000. There aren't as many of them anymore because that model didn't seem to work very well. Again, go back to for every 10 companies you try to invest in, 4 are going to fail, 3 will do well. If you're the person running the incubator, you're going to invest a lot of time and money in a bunch of these companies that are going to fail. It's hard to make money doing that, and it takes a lot of runway of cash flow till you see any cash coming in the door. So they're hard businesses to run, so there aren't very many of them. And the other thing I should say real quickly is that accelerators, certainly Accelerate itself, are really what I refer to as for-profit philanthropy. So the IRS thinks we're a for-profit business, but nobody's doing this for profit. I don't even get a real salary for doing it. Like, I'd make more money being a barista at Starbucks than I do running Accelerate. But the reason we're doing it is the passion, that we want to help create the community. We want to help build this community in Chicago, and those are the kinds of things you want to look for in great accelerators. People who are doing it for the right reasons, not because they think, oh, this is a way I can have investments in 10 companies and make a lot of money, because you're not going to.
I don't think you'd be that happy working at Starbucks. You'd probably end up running 6 of them. Well, why don't you share your resources, and then I will get to a couple more questions, because we have quite a few coming in here.
Sure. So I just threw up a couple of resources, so some great blogs. Both sides of the table, I think I mentioned, that's Mark Suster. Feld Thoughts, Brad Feld is awesome. He's been a big help to us, actually. He helped co-found Techstars and has been a big help to us. ABC is Fred Wilson out of New York, really great blogs about the investing side. Books, I mentioned The Lean Startup. If you haven't read it, you absolutely should. If you're doing something in the startup world, it'll change how you think about things. Do More Faster is a great book. Came out of Techstars. It's like 83 chapters that are 2 pages long, about little vignettes written by different people about their experience going through an accelerator. Really great to learn like all these little tips and what happened. We talked about the business model canvas ever so briefly. Here's a link to get the business model canvas for free. Should be totally free. If you're interested in Lean Startup, go to Udacity. Steve Blank has all of his lectures for his classes that he uses at Stanford. It's class EP245. It is awesome. I'm actually using it in the entrepreneurship class that I'm teaching at Kellogg now. So really, really great, totally free. And if you want to learn more about Accelerate, there's the link to Excelerate Labs. There's a 4-minute video on our homepage, lots of resources in the blog, videos, etc.
Great. I'm just sending out a little information. Just want to let people know that we will also post this information, so they will have that. Okay, so a couple of questions that came in, and one I don't want to miss. It's scrolling up now. So what are your thoughts on deliberately bypassing solicitation of funding and how that affects the overall thought process?
Deliberately bypassing solicitation of funding. I'm not sure I know what that means.
I think my interpretation of the question was that they, are, trying to bootstrap it. I think trying to do it more from maybe friends and family, and if you change the way you look at your end product by how you're asking for the money.
Yeah, so I should be really clear. If you can build a business without taking other people's money, I think that is awesome. I am a huge fan. So I've done it many ways. I've bootstrapped, I've taken VC, I've taken friends and family, I did a private equity deal. And by far, I think the best, if you can do it, is to do it bootstrapping because you are in control. There are many reasons to take money and professional money. There's some businesses you need it to grow. Sure, payroll would cost us over $1 million to build the infrastructure before we processed our first payroll and charged $19.95. We needed venture capital. It's also a great way to learn and to get mentorship and to get guidance. So there are lots of good reasons to take money, lots of good reasons not to. If you have decided that you have a business that you can grow without taking money and you want to do that, stick to your guns, absolutely. So the fact that people are coming to offer you money is a great sign that they respect what you're building and think it's valuable, but that doesn't mean you should take it. It's sort of like the bank always wants to give you a loan when you don't need it. They'll give you the umbrella when it's sunny out. If you don't need it, don't take it.
Okay. Someone sent in a question saying, is there a point that you have a solid, viable idea and should move to the next step? I probably think that's in your gut a little bit, but what do you think? Is there something that says, okay, now you're ready to go? When you start thinking about marketing channels.
Right. We're looking for a repeatable process. So, it's easier to see when you're doing stuff with large numbers, so like consumer-facing. So if you have a consumer-facing site, for instance, and you have proven that you can acquire customers at a lower cost than your lifetime value of that customer, so whether you're selling them something or it's advertising, whatever the revenue, when the metrics start to work and your cost of acquisition is less than your lifetime value, now it's time to start scaling. And it's repeatable, right? So you're doing it by using certain techniques, whether it's social media, whether it's SEM, SEO, etc. In B2B, many times it's a little harder to see because they tend to be bigger deals further apart, and so you don't have as many data points. And with fewer data points, it's less predictable. So the law of big numbers, like at Sure Payroll, we had tens of thousands of customers, and we knew that the average customer was going to run payroll 2.61 times a month. And if it went to like 2.63, that was a windfall for us. Like it was that tight because it's, statistically, once you get statistically significant, it works. So when you have a model that appears to be working and repeatable, that's the time you start really scaling it.
Okay. Oh, some great information here. Okay, I have a proven business model, meaning profitable stores, and I want to go from 3 to 30. I think that's what we talked about. Sort of, okay, what do people do for next steps? Is there a better likely source of funding to focus on at that point? Is a 17% to 20% return attractive at that point? Do you want to talk about sort of next steps?
Yeah, so I think I heard the word stores in there, did I?
Yes.
Okay, so this sounds like a retail establishment. So this is very different from what I deal with. This is not my area of expertise. I tend to work in digital technology. But with stores, you're going to fund it differently, right? So a 17% return is not a great return for a venture firm. Remember, if they're going to invest, they're looking for a way that they can get 10 to 20 times their money. And sure, if it's 17% per year, if you wait enough years, you can definitely get to 10x, 20x, but that's not what they're typically looking for. So that would be a different kind of financing. There certainly are private equity firms that would love to get a 17% return. You might be able to finance something like that with debt, where you don't have to give up equity, and so you know exactly what you're paying for the money. So if you believe that by taking in $1 million, you can turn that $1 million into being able to pay back the $1 million plus 17% every single year you have it, and you could get a loan at something less than 17%, which you should be able to do these days, you get to keep the difference. You have an arbitrage opportunity, and that's a great opportunity if you're confident in the outcome. But that's a whole different world of financing, and there are lots of people who do interesting things in financing that way. I hope that answered the question.
I think that's pretty good. Okay, so one group says, and I think this might be my last one, so we're getting close, getting help from a university's tech commercialization office. They are putting us in front of potential CEOs. Any thoughts on this?
Be careful. Bringing on a partner is sort of the equivalent of bringing on a partner in marriage. It's a thing that's going to last a long time, and should be selected equally carefully. Some people think it's harder to undo a business partnership than it is a marriage, but be very careful. There are some, obviously universities have ties to some really great people, but just because they're smart or just because they've had success doesn't mean that they're right for you. A great example is a good friend of mine who started a very successful company in middle of 2000. Actually, one of the logos that was on there, certified supplier, he and I started together. And we just operate differently. And he's a square peg and I'm a round hole. And we were miserable being partners. We're still good friends today, and I want to be clear, it wasn't a matter of trust. It wasn't a matter of having confidence in the other person. It was a matter of how we operated, and we operated so differently that we were just really bad business partners. And we will never be business partners again. We'll be friends. We'll help each other. I send him referrals all the time. I use him as a mentor in my class, but we're just different. And that stuff matters. So just because a university recommends a CEO who's been successful, you want to make sure that you have aligned objectives, that you work similarly, that you're trying to shoot for the same outcome.
Great. We're getting close to the end of the time, so I would like for us to sort of wrap it up here. I just do want to let people know that we try and offer a few other resources for you. We appreciate you being a part of this today. If you're looking for any other ways to sort of evaluate yourself, maybe because if you need to look at a partner, you also need to know your own skills. So we have coaches to help you walk through that. We have an assessment tool. If you want to do some research on the businesses out there, and we have a research tool. If you want to look at what kind of businesses are hiring, who are big businesses out there, we've got the Brown Alumni Job Board. And, of course, if you're looking at networks, mentoring, people like that, we have your great in-house tool, which is Brunette, and we have a huge LinkedIn general group plus many small groups. Troy, I can't thank you enough for being with us today. I know we've all gotten a lot out of it, and you're so kindly giving us your information that we can share. There's a couple of questions about if we're going to offer this information. I will post some of the key resources, as long as it's okay with Troy, onto Facebook. And then once the recording is ready, the slides and the recording will be available to everyone. I do ask at this time that you take a few minutes to answer a poll that we've put up there. I would also like to let you know while you're doing that we will continue the conversation. We have 2 more webinars that are currently scheduled, plus several more in the works. Our next presenters are 2 of our coaches back to sort of come back and bring up the career development again and sort of, making sure that everyone's really looking at how to get the most out of it. So Karen Hoffman and her cohorts are going to talk about struggling to balance it all, and Carolyn O., who is a fellow Chicagoan of Troy's, is going to talk about claiming your career vision. Troy, thank you. Do you have any last remarks or anything you'd like to say?
No, I hope this was useful. It was my first webinar where I'm used to seeing my audience when I speak, and so I can get feedback and see what they like or don't like. Please be honest in the poll, because it will both help Brown figure out what kinds of things to do better, and hopefully I'll get to see it, and it'll help me be able to be better at doing these in the future as well.
You will. Thank you so much, and thanks to all of you who are on the call, and we look forward to you joining us in the future.